Good afternoon or good morning if you're on the West Coast. I'm Craig Copeland, the Director of Wealth Benefits Research here at EBRI. I want to welcome you to the final day of our 95th Public Policy Forum, our virtual series this year. Today, we're going to be focused on policy developments and innovation in retirement benefits. This is going to be divided into two sessions. The first one, we're going to be focused in on retirement income products, investments, and withdrawal strategies. We want to get a better understanding of what's available, what people are using, and ultimately about what plan sponsors are looking at to offer these benefits, because in many cases, the plan sponsors are going to be the ones that determine what is available. And then the second half of our panel today is we're going to be looking at alternative investments or private equity. And again, that's another important topic of what's going to be offered, what is going to be needed in the future to offer these most effectively, and then what is going to make plan sponsors be more comfortable to offer these products. Because again, plan sponsors will determine what is available and what isn't available ultimately. So first of all, I want to talk about some maintenance of what we can do for actually be able to communicate with each other. For you that are not panelists, we do have the option to answer questions by using the chat function. You hit the chat button and then a bigger panel will pop up on the right. You could then put in your question that you can have, and then we'll have the Q&A session at the end of our first panelist. And then at the second panelist, we'll be able to answer some questions. We do know that some companies do disable chat. And so if you do have a question and your chat isn't available because of your company's restrictions, you can email me at copeland@ebri.org. So I want to introduce today's speakers for retirement income part. I'll be moderating the session. Kevin Crane, who is currently the Executive Director of the Institutional Retirement Income Council, a senior advisor with McKinsey, a senior advisor with Milken, a council member with the Global Coalition of Aging Advisory Council, and a visiting executive at the Gerontological Society of America. Kevin has over 40 years of experience in the industry, most recently with Bank of America before he's taken on these many roles that he has now. Also, we'll be joined by Katie Hockenmeyer, who is a partner and senior investment consultant with Mercer's Wealth Group in San Francisco. In addition, she serves as Mercer's U.S. Defined Contribution Research Director. We appreciate these two joining us. We're going to start this panel off with some EBRI research that really looks at the importance of one of the aspects that really needs to be considered for both of these investment types that we're going to be talking about. And this deals with liquidity, because we know that there is a lot of workers that will change jobs in any given 1 year, and whether they participate in a retirement plan at that job or the next job really has a big impact on how these investments should be considered or thought about and provided, because liquidity becomes a very big issue. So the study we're going to have has been worked on by EBRI Research Associate Kyle Badu. We're trying to determine out what happens at job change with retirement plan participation. And one of the big factors here on the overview is that we know that workers have a median tenure of approximately 5 years. So that means that they're going to have many job changes over the course of the year. So we want to really get an idea of how many of these job changes result in retirement plan participation changes, and to really understand how many of these job changes over a year. So we're going to be looking at the same individuals through the full cohort of their working years. And we're going to be looking at how many jobs they have, what happens when they change jobs, are they staying in the retirement plan, are they moving out of them, and then what does this mean over their entire working career. So first of all, I want to give a description of the data. We're looking at the National Longitudinal Survey of Youth in from 1979, which is done by the Bureau of Labor Statistics. So we're following these people starting when they're age 14 to 22 in 1979, and we followed them all the way. The BLS has followed these same individuals all the way through 2022. So we can find out what happens when they change jobs, what their incomes are, what the retirement plan status is. so we can really get an understanding of who's changing jobs relative to their retirement plan status. So that is what we're going to be looking at as we go through to really understand how much of an issue this is and what we really need to be thinking about, how the impact of job change and liquidity available of assets in DC plans are important for what we're talking about today, and really any issues, potential leakage issues or investment changes when people change retirement plans. So first of all, we want to look at the percentage of workers in this cohort who change jobs. So again, it's for workers in this cohort. We're starting in 1996 because this is the first time they asked about retirement plan status. So that was when these individuals were 31 to 39. And we could see even at that age, we see over a third of them change jobs in that 2-year period. And even as we follow that same group of people out to their 57 to 65, we see that almost a quarter of people change jobs. It's higher for those with lower incomes. It's lower for those with higher incomes. But even for those with higher incomes above median, above 50,000 for individual salary, we still see that it's about 20% of people change jobs in any 2-year period of this cohort as we follow them across through ages. So what does that mean for the number of jobs that individuals will have the course of their life? We focused in on the primary jobs, the jobs that is their most important job in each of the 2-year periods. We take this all the way back to when they start, so that's why we see 1980 and the average jobs is less than 1, because some people still haven't started their career yet because they're 14 to 22. But when we get out to when they're 57 to 65 in 2022, they've had on average 8 jobs over the course of their career. And if you look at all jobs, you can see it's actual 12 for those that aren't primary. They have secondary jobs. So there's a lot of potential for people changing jobs and really what happens with their investments, what they do with their investments, and how it's going to change and particularly bring about a need for liquidity. So let's kind of look at what happens at each interval, each 2-year period for the retirement plan participation. So one thing we have to remember is that these are only the individuals that change jobs. So when they change jobs, you could either start as a state of, well, you had a retirement plan or you didn't have a retirement plan. Those that had a retirement plan can either still have it at the next job or lose it at their next job. Well, those that didn't have a retirement plan could still not have a retirement plan, or they could gain one. And you can see at the bottom, the dark blue is the highest percentage of people are those that went from one job not having a retirement plan to still not having one. You do see about 20% of the people not having a job to then gaining one, but you also see a corresponding percentage of those that had a plan and didn't have a job, didn't have a plan at their new job. So you can see that there is a great deal of moving back and forth. But one thing to kind of think about why that blue is the highest is on the next slide, is that there is a difference between who is changing jobs, particularly at the younger years. Those that did not have a job, did not have a plan, were more likely to change jobs, or were less likely, this percentage is the more likely to have stayed at their job. 50%, 58% for those that did not have a plan, where 76% of those that did have a plan stayed at their job. It does get a little bit closer, but that gives you some of the reason why those at the highest percentage of those, because that was the distribution of everyone that changed jobs. Those that didn't have a plan were more likely to have changed jobs. But so what does this mean over the course of time for retirement plan participation? We see that, at any one point, there's 50% of people that have a retirement plan. But over the course of the career, you can see how this increases. We're adding some people are losing, some people are adding. But by the time you get to their near retirement years, 80% of these workers have participated in a retirement plan. And for those that had above median income, you can see that's 95%. So even though we see that any one point, only about 50, the ages obviously goes up, there is still a high likelihood that people over the course of their career will have a retirement plan, and therefore these issues will be relevant to virtually all workers, particularly those with the above average incomes. So it's something that we really need to be thinking about, is that there is going to be this liquidity issue because people change jobs quite frequently. That 8%, even though that was that cohort that is now reaching retirement, that's something that's not changing. So on the next slide, we could see some of the things that we really need to think about Also, the likelihood of changing jobs does decrease with age, which does gives us some comfort that they're more likely to stay longer as you get or stay till retirement as they get older. Retirement plan participants were more likely to stay at their job, so there is some stickiness for those that do have retirement plans. So that's a positive thing. But we still need to be thinking about how this can roll into liquidity issues when we talk about any of these investments, whether it's retirement income products or it's private equity investments. So I really want to introduce that new research that we have to think about, because we know it's going to be an important topic that both Kevin and Katie will be talking about retirement income side, and our panelists later on private equity. So now I'd like to turn it over to Kevin Crane, who's going to be talking about the overview of all the retirement products and withdrawal strategies that are available in the DC market. Kevin?
Thank you, Craig. And I'd like to thank you and Barb and EBRI for being part of this, and also your continued work to be truly the voice in the industry of the important research that's needed to shape solutions. And I'm thrilled to be part of this with Katie. I will say to start, Craig, when you presented that 8 job stat, I sat here and listed out how many jobs I had. Before I retired from Bank of America, I had 7. So I think I fit that cohort perfectly. So let me talk, as Craig said, around in-plan retirement income, which Katie and I will both talk about. In terms of the Institutional Retirement Income Council, which I'm part of, that's the work we're doing. We actually work in the industry on what is the complete inventory of retirement income solutions, which I'm about to describe, that are evolving quickly. And we work with insurers and investment managers and record keepers and middleware firms about how can we make that a much easier topic for sponsors, advisors, and consultants to really understand, so they start to take action on this. When I speak about the inventory of in-plan retirement income options, I always like to start with a little bit of a baseball analogy. If you think about in-plan retirement income, the evolution of that, the product creation, I actually consider in the later innings. And I'm going to speak about, there are just a range of solutions that are quickly maturing. When you look at the record keeper integration of those solutions, that's more in the middle innings. They're certainly coming to the table quickly to integrate these solutions to be able to offer to sponsors. And then when you look at actually the work I know Katie does, and you look at sponsors and advisors and consultants, they're now coming on the field in this game, understandably, because now they see the record keepers are doing it and they see the range of solutions exist. So if you look at that later innings product manufacturing part, there are a range of solutions. And I think the hardest thing here is to try to keep it as simple as possible, to not overwhelm, for what is a new topic for plan sponsors, consultants, and advisors, to not overwhelm them with the multitude. So I'll try to live to that spirit in how I summarize. First, as an option in plan, is something that's existed for decades, actually, systematic withdrawals. Record keepers have had this technology that a participant can elect to have their amounts paid out to them in orderly fashion, monthly, quarterly, or annually. And actually 70% of plans offer that because it has been a feature in record keeping systems forever. Second, there are now creations of stable value or bond solutions, maybe paired up with a systematic withdrawal, that gives participants can move to a more capital preservation investment, and then have the systematic withdrawal be the ability to pay them out on an orderly basis. Third, and probably arguably one of the fastest, if not fastest evolving topics, are what you would hear are hybrid target date funds. And that will be a target date fund that incorporates a retirement income portion to it that could either be an annuity structure, or it could be a systematic withdrawal feature, that in that target date, participants can stay for a portion of their balances invested in the longer term as they've done through accumulation, but then choose to defer in amounts into the annuity section as they age or approach retirement, to have that part be paid to them as orderly retirement income. Fourth, kind of alongside the target date, the same concept for managed accounts, hybrid managed accounts that either could include as a retirement income portion, the annuity portion, or the systematic withdrawal. And then fifth, there are and actually these have existed in plan provisions for a long time, there is the option to distribute to an annuity. So there are record keepers that are offering a supermarket of annuities. And then usually alongside of that, to help the participant decide, they offer some level of a counseling service so the participant can model and counsel, given there are different types of annuities, what's the best annuity. So that's an inventory of solutions that exist. What's come off of that as that's quickly evolved are some themes. One is when you look at some of the hybrid situations of the annuities or the systematic withdrawal within the target managed account, the discussion's now beginning. Should that be a participant election of how much to put into that retirement income side of the investment, or should that become a default, understanding that things like managed accounts and target dates overall have been defaults? That's still in a discussion mode. I mean, there's been some work by the DOL ERISA committee and other places to begin to look at that. Second, there's certainly the theme emerging here on portability. And that is a discussion point. So what is the portability factor? If plans change record keepers, how would that work? For the participants themselves, how that would work? And then third, in all these solutions, there continues to be just levels of customization, which is not unexpected, but there's a lot of innovation and customization. And then I'll finish up before I turn it to Katie is, so how is this working from the record keeper perspective as these solutions have been created? Record keepers historically did a little bit in this, right? Systematic withdrawals and partial withdrawals. Well, now they're coming full into this equation. And the major record keepers are all doing some flavor of this, but they're doing different flavors of it, which is interesting. So you are seeing record keepers implementing these solutions. What's coming alongside of that is the introduction also of middleware technology. So the middleware technology and those entities are partnering with record keepers. So when let's say a participant is in a hybrid target date and they're taking their assets out of the investable side of the target date and putting it in the annuity part, what is the participant experience, which is where the middleware technology is coming in place to make that participant experience for their move into the insurance annuity part with their assets and then their relationship with the insurance annuity partner ongoing. What is a user experience that's as seamless as possible with the record keeper of the retirement plan and then this insurance component? So that's quickly evolving. So I think the last thing I'd say from a record keeper perspective is all of this activity will change the definition of how they view retaining participants. It used to be retaining participants was they eventually leave the plan, but could you retain them in a rollover IRA? Well, now in all of this, there's a great interest, and plan sponsors have taken a different attitude than they used to historically about participants staying in plan long-term post-retirement is not a bad thing. And there should be ways to service them and give them the institutional advantages of the plan. So I will turn it back to you, Craig.
Thank you, Kevin. Katie?
Thanks so much, Craig, Kevin. It's great to be here with you both, and thanks to EBRI for having me. I'm going to share a little bit more about what we're seeing from an adoption standpoint. And Kevin, I think you started to touch on a lot of this, which is phenomenal. One of kind of the no-brainers that's been out there for the retirement income discussion is around plan design features. So looking at things like systematic withdrawals or giving more flexibility with withdrawals in plans as well. And that's been kind of the easy flip the switch for many plan sponsors. Sometimes there's plan amendments evolved depending on how the plan was set up originally, but that's been kind of one of the first steps that we've seen many plan sponsors take. Expanding on from there, another thing that a lot of plans have already had for quite some time is managed accounts. And so a lot of plan sponsors that have offered managed accounts historically is really a way to create customized portfolios or more personalized portfolios for their participants, have been having discussions with those managed account providers to look at other features that might be turned on to help with that decumulation conversation. And that can have a really wide expanse. It can be, those managed account providers can help support not only investing of the assets to help support certain rates of decumulation, but also recommendations and strategies for balancing decumulation needs in retirement. So helping to determine when you should take Social Security, balance that out with maybe a small pension benefit that you have from a prior employer. A lot of this, though, is very dependent on participant engagement, and that's where kind of there's oftentimes a big hurdle. A lot of participants don't start actually engaging and thinking about this until they're 10, maybe 15 years out from retirement, and that's fine. And managed account providers in that instance can absolutely start to help at that point as well. But it is something that we're seeing, wider, I would say, adoption of, or I would say more of a morphing really of the service offering that has already been in place for many plan sponsors. If we kind of continue down the ladder, and I'm going to we start at the top of the funnel with the plan features, managed accounts, and I'll kind of continue on down. Some of the other things that we've seen get more traction out there is reframing investment menus. So capital preservation options, in particular stable value, have a lot of features in it that actually are intended to help provide some stability for decumulation needs in retirement. Stable value in particular aims to kind of have a more consistency of returns with crediting rates. And so, and the accounting mechanism that affords, the guaranteed book value plus accrued interest for participant withdrawals. So a lot of plan sponsors have kind of been in educational materials highlighting those types of plan options that already exist today. And then we get down to target date funds. And this one is kind of an interesting mechanism to think about. Two schools of thought on target date funds. There's target date funds without guaranteed components and target date funds with guaranteed or annuity components. The large portion of USDC plans obviously have target date funds, many as their QDIA, without a guaranteed component. Target date funds, in many instances, were created specifically to support participants into retirement if that participant leaves their assets within that target date suite. These asset managers are making a lot of assumptions about spending behaviors in retirement, tapping into kind of broad US data to design that asset allocation. Some of those providers have a static approach. It's a fixed allocation once you hit retirement. Others have kind of more of a de-risking strategy to help replace spending that happens more heavily in the first few years of retirement. Lots of various approaches. And so the vast majority of plans offer that. But sometimes what we see happen is that participants who may have been invested in target date funds leading up to that retirement date then actually uninvest from those target date funds. They're, either looking to other investment options because they've become more engaged in their retirement planning, looking to maybe increase their overall pot of money through more aggressive options. And I'm making very broad generalities here, but these trends tend to happen across a number of plans. And so one kind of interesting tidbit here is that for many plan sponsors, they already have somewhat of a tool through their target date funds to help support, at least from an investment allocation perspective, some type of spend down and replacement in retirement. But that's not really been an area of focus. Really what we've seen more, and so lately with a very explicit focus on retirement income, is the target date funds with an embedded annuity component or an option to annuitize. Most of the off-the-shelf products that have come out there have started to gain traction, have started to gain funding, but it's at very low levels, maybe a little bit over a dozen plans, low 20s in aggregate across some of these products. And something that's all kind of a constantly moving target. We do anticipate over time that those offerings will become more prevalent in the marketplace. I would kind of liken it back to when target date funds were originally put out, very low utilization compared to balanced funds or target risk funds. In the DC space, PP&A had a lot to do to help with the adoption of target date funds as well, or increased allocation to target date funds. But gradually over time, there was more adoption of target date funds in DC plans. And I think, we might not see the exact same levels of adoption that we see with just target date funds without embedded annuities today in the long term, but I think that you're going to start to see more adoption over time, and we'll have to kind of look at this over 5, 10, 15 years. Within the asset management space, there's definitely a bit of a mentality of if you build it, they will come, and a need to be patient with DC plan participants, because there is a perception bias, absolutely, that we've seen from focus groups and various research studies around annuitization. A lot of individuals, especially those who are in kind of that very near window to retirement or in retirement, can have a bias against annuities. And that is because most of their understanding of annuities is often a retail interpretation. Sticking on the topic of annuities, we see very low prevalence of just standalone annuities in plans. So participants being able to elect fully an annuity as an investment option. That is something that, we don't necessarily anticipate increasing significantly. We think these more multi-asset type fund structures with target date funds are going to be a path that gets a little bit more attention. but also we are starting to see these institutional annuity buying windows. And Kevin kind of talked about this a little bit. And these are gaining a lot of interest. There's a lot more flexibility around these institutionally priced annuity buying windows. And there is, help for participants, guidance in terms of calculators, and to Kevin's point on the middleware connectivity to these annuity providers that can be pretty effective. So we've actually seen a pretty large adoption rate for how new these institutionally priced annuity buying windows are. Also anticipate some continued growth there. Lots of factors are going to affect this, and depending on what path is right for a plan sponsor, there are many different options out there. We really encourage plan sponsors to look at their demographics to understand what makes the most sense for their population, to think about philosophically, what's going to fit those needs, how can you educate, and communication is absolutely key, and education is absolutely key in terms of kind of really getting any traction for these designed products. When we look outside to other countries as learning points, some countries have historically had mandates for annuitization. The UK is a great example. That mandate has actually been removed, and yet we're still seeing actually increased rates of annuitization in the UK, particularly recently with a more high interest rate environment kind of present. And so that's kind of an interesting example for, 10, 15 years into the future, as participants kind of get a little bit more comfortable with these institutional annuities. Maybe we'll start to see kind of rates tick up a little bit as there's better understanding in terms of how these annuity components can fit into a broader retirement picture. We do not anticipate participants annuitizing their full account balances, probably, in my career here at least. But we do anticipate some increased traction over time. So Craig, I'll go ahead and stop there.
Thank you, Katie and Kevin, for your remarks. If anyone has any questions, please put it in the chat. We do have some questions that I'll start with. Kevin, do you see any particular product or strategy potentially winning out, or some new strategies coming on that will gain significant market share of those products you were talking about, or those you haven't mentioned?
Yeah, I mean, I'll kind of go right along where Katie was going, because she was truly the voice of the client there. To her point, I do think these hybrid structures, when you look at the managed account and target dates, seem to be the ones that will at least have an early lead and probably will gain in popularity pretty quickly. A few things in that. I mean, one of the issues here out of the gate, understandably, is this is new to plan sponsors and consultants and advisors to some level. And there's some level of a fiduciary process here to review and decide and select these options. So when you look at a target date or managed account, now adding in, as Katie said, a retirement income feature, there is familiarity overall with those investment structures, the managed account and the target date. And there are fiduciary processes that are in place. Now, they need to extend a little bit more to consider the retirement income part, but I think that really has given some tailwind, obviously, as well as as Katie said, why the individual annuities probably aren't as popular. In the hybrid case, the ability for the participant to remain invested longer term with great longevity trends that are out there, to remain invested in part of their balance longer term and only take a portion of their balance and annuitize it, also seems very attractive. So I think those two things. The other one I was fascinated by, and I was kind of shaking my head as Katie was talking about it, and I have to send her this after the call, her conversation about stable value and the capital preservation. I think those will, now with the interest rate environment going where it is, those will also be interesting to watch, because it's actually a form of insurance, but it's a different form than an annuity. But I agree with her, and actually IREC with the Stable Value Investment Association is thinking about this topic in terms of a research piece. But I agree with Katie on that. Again, stable value is known in plans. It's known, it's been evaluated, it works, as well as other capital preservation options. So that combination with some sort of withdrawal feature, I agree with her. I think that will be something else to watch in terms of its momentum accelerating.
Thanks. Katie, do you think there's something more for like regulations or products that plan sponsors would need to offer these types of options?
That's a great question. I think that, with Secure, that gave some helpful guidance in terms of some fiduciary safe harbors. It can just take time for that kind of, that kind of guidance, effectively implied guidance to really come out and bear in terms of the fiduciary decision-making process. I can tell you that a lot of fiduciaries right now are educating themselves in terms of what are those safe harbors? What would the fiduciary responsibility be in terms of assessing an insurer? But there's also this balanced aspect of, a little bit of fear of litigation risk. So we haven't necessarily, we've had some litigation, especially on the pension plan side around insurer selection and all of that. Even though there's IB 95-1 on that side giving some additional guidance. And a lot of DC plans look to that IB 95-1 for guidance in terms of what they should be evaluating in addition to those safe harbors provided. So I think that there's just a little bit of uneasiness in terms of the litigation front that's just making plan sponsors be kind of slow in terms of wanting to take their time to understand really what can we do as a fiduciary to make sure that we have a prudent process in place, that we're evaluating these correctly, that we're reacting to anything that we need to going forward. So that's one element at play here. There is kind of an interesting relationship when you get into some of these target date funds with embedded annuities, because it basically puts one level of removal between the plan fiduciary committee and the annuity provider selection, because most of those asset managers are taking on that fiduciary responsibility for selecting those insurers. So I think that, as plan sponsors start to understand how those asset managers are assessing the annuity providers, you can probably see a little bit more comfort with that type of a model gaining some traction, if those plan sponsors feel like that's the right type of a model to use for their participants. So I'll pause there, Craig.
Well, there's a follow-up question on that. When do you think it could potentially be a liability to not have this option?
That's a great question. I think that I truly don't think I can put a time limit on it. I think it's going to depend on a lot of different factors. Kevin, I'm curious if you have any thoughts on that.
Yeah, I mean, it's an interesting point. I was shaking my head at it because it kind of parallels years ago the topic of financial wellness, and financial
Yeah.
wellness programs and the reality of those. I don't, to Katie's point, I can't pinpoint the exact point that that's the case. I mean, historically plans did have some features you could argue, be it a systematic withdrawal, be it partial withdrawals. I mean, you could even argue, obviously, required minimum distributions, albeit a different type of retirement income strategy, is a retirement income vehicle. So I think you could argue plans had something maybe in there to do it that could cover their fiduciary thing. But to Katie's point, that's something to be considered. I don't see it on the immediate front that plans are going to rush to do this because they fear they're going to be sued because they haven't done it. I think it's more the reverse of what Katie was talking about wanting to be prudent when they put it in, that they feel comfortable that they put the right thing in.
What about portability of these product insurance credits? Even if you talk about stable value, if you're trying to convert to a new plan on stable value products, how do you think this all plays out? How do you think it's being addressed, and has it been addressed well?
Do you want me to
Either
start?
of you, both.
He's looking at me. I'll start.
Kevin, why don't you start and I can add on.
I think that's I put that out there as one of the biggest evolving issues because I still think that is, if not one of the two or three biggest issues right now, which is being looked at seriously. And you have portability. I think this question was phrased in the portability from a plan sponsor perspective, right? They move, right? Record keepers. And you have a few issues in there. They could move record keepers and they could be, let's say, in a hybrid target date structure of a certain investment manager on one platform, the record keeper, but they move record keepers and the other record keeper that does not have that. I mean, they may have a hybrid target date, but not that particular investment manager, or in the case of stable value. So, I mean, I think that is the biggest probably evolving topic in terms of how will that be addressed. I don't have the clear-cut answer sitting here, which I'm not surprised because these products have just been created, but it's clearly one of the biggest identifiable items that need to be addressed quickly to get more comfort to adopt these and implement.
I think, Kevin, I'll take the other side of it from maybe a participant lens, and then I can talk a little bit about stable value in particular. But just on the participant lens from an annuity perspective, once a participant annuitizes, the contracts by and large, depending on the arrangement, sits just with that annuity provider. And so therefore it is in a sense portable. So participants can, move the rest of their assets to a different plan if they want to after they've annuitized, based on different plan permissions, or roll out to an IRA, whatever, is allowable truly. So that there is the hope there with that design mechanism for really making sure that contract sat with the annuity provider and was just going to be individual between the participant. That was very purposeful with the design of a lot of these products to ensure that there was flexibility and to ensure that the plan sponsor could then change record keepers and not have to necessarily worry about those contracts that were already initiated. On the stable value front, I know that there's kind of a question around conversions and record keeper conversions. I think that, with the way that we tend to advise our clients around stable value and record keeper RFPs and transitions is you should be looking at record keepers who can support open architecture for your plan. That should be a criteria in the record keeping RFP process. I would say, not in every instance, and there are unfortunately differences in terms of the market size for the plan where we see more favorability towards open architecture versus less. But we have seen a significant improvement in that over the last 10, 15 years, absolutely. And there is much more of an expectation, with record keepers that kind of a question is going to be included in an RFP, that there is an expectation that you need flexibility with the investment options and more open architecture. It's not perfect. I fully understand that. And it does, definitely depending on the type of stable value product, if it's purely, a GIC, an insurance account versus a more synthetic implementation, there definitely can be problems still there.
I have a question for myself. What was the length of the participation that you saw of that job, of those individuals and that stayed with their same job? And we could see that there is a core group of people that have retirement plans participation their entire career. You'd see like about 50% of those that have a job seem to have it their entire career. But you get that other 50 to 70% of people that are changing jobs year to year. We actually add an additional research that shows the distribution of those, the number of years that they actually participate over the course of their life. And you do see that there's a core group that has it their whole time, but there are other people that only have it a few years that have it most of the time. So that's something else to be thinking about, is that, well, there's going to be some that only have few, but there are those that have it for their entire lifetime. So that does become an important part. One last question. I think, Katie, you talked about a mandate. Let's not quite go to a mandate, but how about, what do we think about a default at a particular age into the annuity products? And Kevin, I think you'd have some good thoughts on this too. And, would plan sponsors adopt it? Do you think it would be good to do in general? And if plan sponsors would feel comfortable adopting it?
I can start on that one, Kevin. I think that plan sponsors would want to see something legislated or some rule making happen before they would probably feel comfortable with that. I could see some softer forms of that happening, Craig. So for example, as depending on the profile of your population, maybe as participants get a little closer to retirement, you tack on financial coaching sessions that talk about these different retirement income options when you do annual reviews, and that could be, an added benefit, so to speak, to those participants. I could see something more like that happening sooner versus later without any, specific legislated or regulatory guidance. Kevin, curious to get your thoughts.
Yeah, I'm going to go right where you went. I agree with that. I think right now with the plan sponsor just getting comfortable about putting these options in, particularly the hybrids, it's a bridge too far at this point without more regulatory or safe harbor guidance to default people, I think, concerned over litigation. But to go where Katie went, I think another thing in this, and she just said it, is a critical success factor in this, and actually get participants to understand and utilize, is improved pre-retiree education. Financial wellness has been great, done a great job in early mid-stage careers, but more robust pre-retiree education at age 50, 55, and 60, like Katie said, looking at Social Security and Medicare, integrated retirement income projections. How do you create your income? I agree with Katie. That's a really big component. And if that works, you may not need to get as much into the concerns about defaults of people into the retirement income part.
Well, I want to thank Kevin and Katie for joining us. Now I'm going to hand it off to Barb, who's going to start talking about private equity.
Well, thank you so much, Craig, Katie, and Kevin. Kevin Crane. We have a new Kevin joining us, actually. It is just really fascinating. And Katie's actually going to stay on with us through the discussion of alternatives in DC plans. But let me quickly introduce the two new folks joining the panel. First of all, Jonathan Epstein is the president and founder of the Defined Contribution Alternatives Association, DeCalta. Jonathan has over 30 years of experience in the retirement services industry. And if you're not familiar with DeCalta, the organization's mission as a nonprofit, it's dedicated to advocacy, research, and education for stakeholders on responsibly incorporating private markets within a DC framework. And we also are fortunate to have Kevin Walsh with us with Groom Law Group. Kevin co-chairs Groom's fiduciary practice group. He advises clients on a wide range of fiduciary matters and other issues around retirement plans, especially defined contribution plans and IRAs. He's very involved in bringing innovation to the 401k space. And part of his practice is also working with the Department of Labor, the CFTC, the Office of the Comptroller of Currency, OFAC, the SEC, state insurance commissioners. So it'll be very interesting to hear some of the most recent conversations with some of these agencies about what's happening here. So welcome, everyone. And we can get right into the conversation. Great. So many refer to the inclusion of private market assets in 401k and other defined contribution plans as democratization. It's a leveling of the playing field where for 401k investors, since private market investments have been available to high net worth investors and institutions, including as part of pension plan assets for over a decade. And this is big business. One study showed that a 10% allocation of company-sponsored and self-directed IRAs and 401k plans to alternatives has the potential to shift $3 trillion from traditional asset classes to alternatives over the next decade. According to some recent surveys, and these are not EBRI surveys, there is demand from the public. These surveys say that close to 3/4 of the public support the president's executive order. 73% of retirement plan participants want their 401k and retirement investment menu to look much more like the investment options available to institutional investors. And many participants believe that some private market investment exposure could improve long-term retirement outcomes and say they would allocate a modest percentage of their assets to alternatives. So demand seems to be there. But on the other side, there are consumer groups and also outspoken politicians and others. It's a very emotional, kind of dramatic issue that believe that this is just a bad idea. And concerns range from issues like higher fees, lack of transparency, weak regulation, illiquidity, and really wanting to make sure that we can protect the end investor from fraud and bad actors. And others say there really just aren't simply enough good deals to go around. So who's going to get the best deals? But those in the middle ground say, let's let plan fiduciaries decide. Private markets and defined contribution plans, they shouldn't be mandated and they shouldn't be banned. Fiduciaries should be able to offer these investments in their plans if they feel they are prudent. So wanted to set the context that way. That's kind of the landscape of the emotions around the issue. But I'd love to jump into the discussion first with Kevin. Can you first of all clarify, we've got an executive order out there, and I think there may be some misunderstanding on what an executive order is and what it isn't. And then if you can help us a bit with what are the regulations that currently exist here that could be, that could be leveraged or pointed to, including ERISA. And then finally, how does the SEC definition of accredited investor fit in here? So if you take us through that, I think that would be great to really just help set the stage.
Thanks, Barbara. And those are great questions, and thanks for having me on today. there's been a lot of confusion about the executive order because it got a ton of publicity. I think it was front page news in the Wall Street Journal, front page news on the Financial Times. It made the news wherever it was. And I think there's some sense that an executive order is a little bit like when God gave the 10 Commandments to Moses. It's heaven coming down and saying thou shalt, and suddenly the whole world changes. A statute may be like that. Even to some extent, like a regulation or sub-regulatory guidance might change the marketplace. But an executive order really is a whole lot more like a memo from a boss to employees. So, my boss tells me, Kevin, I'd like you to make it easier for folks to think about including private equity in their 401k plans. I then have to go, do something with it before it has an impact outside of my business. So essentially what the executive order did was, it was the administration announcing its policy, which is it wants the agencies to facilitate the inclusion of private markets. It specifically told DOL, look at old guidance, see if it needs to be updated. Think about new guidance around fiduciary responsibilities. And it told the SEC to look at other ways they can facilitate. But at bottom, it puts us waiting for the agency action. If I'm an investor today, it doesn't change the fiduciary landscape that there's an executive order. What it tells me is there's changes coming down the road. So that I just want to clear that up at the outset. EOs are very newsworthy.
They sound more official than maybe they are.
But they've got to, they take some other people acting before they get implemented. President Trump isn't going to walk around and sit in each fiduciary committee meeting. It's going to take action from the Labor Department before rules change. Now, I guess you asked also, what are the current regulations around this? What does ERISA require around investments? ERISA, it's the statute that governs pension plan investments. And when I say pension plans, I mean both defined benefit plans and defined contribution plans. Barbara, you made a great point, which is that defined benefit plans have allocated to a wide variety of asset classes, including private markets, for the past 40 years. Which, it does suggest a little bit that when it's the employer's money and the amount they have to contribute goes down if the investment does well, that employers are comfortable investing in private markets, knowing that they'll have to contribute more if they go down and contribute less if they go up. So when they bear the risk. But for some reason on the 401k side, where it's the participant who gets the benefit, we're not seeing them offered, or the risk it's not being offered. But it's the same framework. ERISA doesn't have a set of rules for what a prudent fiduciary thinks about for a DB plan versus a DC plan. At bottom, there's really two fundamental responsibilities of an ERISA plan fiduciary. The first is to act like a prudent expert. And if you aren't a prudent expert, go find one. So, if you're Joe's mechanic shop and you say, shucks, these are the investments I understand, so I'm going to pick from the investments I understand. I'm not satisfying my fiduciary responsibility by saying I'm limiting the world to the things that I understand. I've got to find a prudent expert so that I can figure out what's going to maximize retirement security for my participants. And the second responsibility is I've got to act solely in the interest of my participants. And, this is kind of a conflict area there. I can't say, that investment's going to give me a kickback, so I'm going to go with that one, with this one over another one. So two responsibilities: act like a prudent expert, and act solely in the interest of your participants. In terms of how that's been clarified over the years, in terms of private markets, there have been a number of kind of requests for sub-regulatory guidance from the Labor Department, whether it's swaps, whether it's other things. They've issued a number of letters. The letter that's most on point is in 2020. The Department of Labor issued a letter to John Breyfogle, one of my colleagues, that talked about how a fiduciary can prudently consider allocating to private equity in an asset allocation fund. New terminology, I think it just means target date fund or balanced fund. They choose to use a asset allocation fund as their word, but they explained how one can prudently do it. In 2021, the Biden administration issued a supplemental statement. The supplemental statement essentially said, hold your horses. We're leaving the Trump letter in place, but we don't want it to be perceived as an endorsement of private equity. And so that was perceived as a little bit of cold water. Most recently, after the executive order was issued, the Trump administration revoked the Biden supplemental statement, saying, hold your horses again. We think the Biden statement threw too much cold water on private equity. And so, it seems like both Republicans and Democrats are saying you can do it, but they're really fighting over how warm the bathtub should be. Looking at, the SEC side of the house. Now, the SEC side of the house is really where it comes into what type of products can be put in plans. So if we wanted to put, if Jonathan Epstein was here with his Dekalta private equity fund, he's offering this standalone private equity fund. And he asks me, can he put it on a plan lineup directly? I'd have to tell Jonathan, the Department of Labor rules don't seem to prohibit that. But if you want to do it from an SEC standpoint, you better make sure as heck that every participant in that plan is an accredited investor or a qualified purchaser. And then he'd turn around and say, well, come on, no plan can guarantee that. So then we've got to dig into the SEC rules. And the tragedy here is the SEC rules originate from this 1941 General Counsel Memorandum, which, very old guidance, predates ERISA, very focused on the idea that we don't want, and it's almost like the digital asset thing where we're worried that folks are going to YOLO. You only live once. I've got to get into this private investment. And so essentially, since then, they've issued maybe 5 or 6 pieces of paper in various sources that you have to kind of mash together to look at the rules for how you can incorporate private market investments into a 401k plan without having to look through. At bottom, it's doable. It just requires some opacity. So you essentially can't tell participants a lot of detail about the specific funds or the specific allocation. And you've got to keep your allocation to any individual private fund realistically below 40%. And so, you can do it today. The guidance is there, but it's a weird landscape where, DOL is still trying to figure out how warm to make the water. And the SEC has rules that essentially say you can do it, but kind of in contrast to everything else we see in the investment landscape, the message is you can do it, but you've got to be secretive.
Okay, that is an excellent grounding for all of us in the current landscape, the executive order, and what we all need to keep in mind. Thank you so much for that, Kevin. So Jonathan, I wanted to turn to you. And you mentioned during our prep call that you believe there's a number of myths out there around incorporating alternatives in defined contribution plans. And you'd like to bust 1 or 2 of them. But one of the myths is that it's going to be the wild, wild west, as you called it, and that plan participants are going to be investing directly in private equity via the plan menu. So based on what you're seeing, how do you see the market evolving here? Including there's a number of really interesting products that have very recently come to the market via partnerships. And how will some of these new products address the concerns that have been raised?
Yeah, thank you, Barbara. And thanks for having me. The Wild West, when we had taught the Wild West analogy, it certainly makes a great headline when it comes to private markets and DC plans. But if we're using that type of narrative, the buyer beware narrative, that should be equally applied to all asset classes, especially within an ERISA plan. And I guess the beauty of ERISA, which both Kevins touched on briefly, is that it sets the bar at the highest level for fiduciaries, and that directly impacts then the firms that actually want to enter into this space. So the fact that all retirement plans that are qualified are wrapped with ERISA, it then extends out to the firms that want to work with plan sponsors, they want to work with target date fund providers, as well as the advisor community. When we look a little deeper into where ERISA covers the private markets and the intersection of DC, it mandates that the cost be reasonable. So a lot of the conversations, a lot of the headlines that we see are focused strictly on private equity. They're focused on the cost of private equity. Where the conversation should actually take place is from a value for money perspective, not just the cost side of it. And I think Katie can touch on this as well, but whether that's deciding, let's say, on paying more for certain types of strategies to either enhance growth, whether it's to minimize the risks for a portfolio,
I think most of us on this call understand that private equity, the private markets, they cost more to administer, and that has to take place when fiduciaries are considering these. We've put out a lot of research for the past 10 years. Decolta has existed to serve as that information bridge between the alternative investment firms and also the plan sponsor community. Um, the the fact that fiduciaries engage an expert when they don't have the requisite knowledge, that's part of ERISA. And what that then extends to, it extends to the advisor community, the consultants that are dealing with the plan sponsors to educate them. And we can talk about education in a little while. But ERISA also mandates diversification and transparency. And one of the stats that's impressive to me and shocking is that 99% of the businesses in the United States are private. So that means all of this time, a lot of the DC participants have only been accessing 1% of that market. And that's where private markets are certainly, they could provide the diversification that's needed. That you touched on a myth about the Wild West, and certainly the headlines have picked up on that. And we've been doing, again, this for 10 years. And the industry has come together, and the industry has come together not only to look at the best method and the best solutions for plan participants and how this is going to take place. There was a piece of research that Cerulli and Decolta had done that was put out today. And I would welcome everyone on the call to take a look at that, where we actually do look at 4 myths. I would say there's probably around 7 or 8 out there, but we did focus on 4 of those. One of the myths that participants will invest directly in private equity funds on core menus is something that has been talked about for a while. That's not how the industry is viewing this. The industry is viewing that, just like on the guaranteed income conversation you had with Kevin, is that private markets will be available through professionally managed solutions. They're multi-asset in nature, so that helps with the liquidity requirements. They'll be diversified, and they'll be within a modest allocation. All of that, again, surrounded by ERISA, so it's in the best interest of plan participants. So
That's really
that
helpful.
helps with
No,
2 minutes.
that's great. Thank you so much. So I've seen studies, again, these are not EBRI studies, but I've seen studies that have shown that participants could see a 6 to 8% improvement in retirement income after fees, with even a modest exposure to private markets and target date funds. And I've seen numbers as high as 15% of the impact of retirement income on retirement income, including alternatives and retirement programs. Those are big numbers, not trivial. But yet, currently, only a small number of plans offer alternatives. A bit more include real estate. But some of the newer surveys are saying that more plan sponsors are considering adding alternatives to plans, mostly via target date fund, I think, Jonathan, as you're suggesting. So, Katie, can you give us a view here? Plan sponsors, just as we were talking about with retirement income conversation, they're the fiduciaries of the 401k plans. Ultimately, they get to decide whether it's prudent to add alternative investments to their investment lineups. So what are you hearing from the plan sponsors that you work with? And, we talked about litigation risk before. I think perhaps even a potentially the bigger issue here. What are you hearing?
Barb, great question. And thanks for allowing me to stay on this panel too. So I guess a couple quick things I'll touch on before I dig into that. The first is just to level set on the alternative investments that were touched on in the executive order. Alternative investments kind of have been defined now through that executive order. And so they range from everything from private investments, private equity, private credit, private real estate, private infrastructure, to commodities, to retirement income, longevity risk sharing pools, to digital assets. And so I just wanted to mention that because I think some of the studies that you're mentioning focus a lot on the private investment piece of it. And I think that's really important to distinguish, just as plan sponsors are kind of trying to reconcile those studies with the executive order and what's kind of covered under the alternative investments. So as we think about that breadth of the definition there, We have seen increased questions from plan sponsors since the issuance of the executive order. Mercer had put out a paper in 2024 around, how in theory would you go about doing this? The marketplace has changed. And we saw some inquisitiveness around that as well as we were talking to clients. Most of the clients who are asking questions around that are very large plans, often have experience with private investments in terms of investing through a pension or the like. And so they feel much more comfortable having these conversations. They also, in many instances, feel like there's a bifurcation in their workforce where a portion of their workforce technically has access to these investments through a pension plan, and maybe the other portion of the workforce that doesn't have access to that pension is not getting that potential benefit. And going back to what Jonathan said, there's definitely, undisputable evidence that a lot of the capital markets globally are held privately. And so DC plan only participants aren't getting that access. So that's one tenor of the conversation, one type of plan sponsor, I would say, that's kind of evaluating these types of private investments. It is not happening in droves by any means. It's really just more educational in nature. The other thing in the spike up that we really saw following the executive order was really more interest from financial services types of firms. So many of these firms being asset managers or having a lot of experience with private investments in particular, or digital assets in particular, kind of saying, this is really interesting. Let's start to learn more about it. How could we go about implementing this? So I think we're really at more the educational stages versus, actual pursuit of implementation on the whole. But that's kind of what we're starting to see. And one of the things that we've been discussing with plan sponsors, and kind of going back to the fact that the intention for most of this exposure, especially private investments, would be through multi-asset solutions, target date funds, is that if you think about your target date funds, they almost are intended to kind of function like these mini pension plans in and of themselves. They have regular contributions coming in from the employees. They're diversified. The modeling of the allocations are expecting some type of liability to be withdrawn from the target date funds at some point in time to get to a certain income replacement ratio. And so as you kind of think about that profile, it could make a lot of sense to include private investments. And also what you tend to see within the target date fund space is a little bit more predictability in terms of cash flows, which again is important for private investments that have a different liquidity profile, different capital call structure, depending on the type of vehicle you're using. And so that's kind of an interesting area, and the types of topics we're starting to talk about with these with these plan sponsors. And if you think about it in just a demographic light, plan sponsors that have things like auto enrollment into target date funds, especially at a decently high percentage, can really start to get a better sense for what those cash flows are like, maybe get a little bit more comfort with the little bit less liquidity that some of these private investments are offering compared to the public counterparts that are kind of being allocated to within a target date vehicle.
Oh, thanks for that view, Katie. It's interesting to hear sort of where plan sponsors stand. I just wanted to ask Kevin, if I could just ask you a follow-up question. Katie, you went through the different categories. From a policy perspective and from the agencies, is like digital assets and crypto, do you feel like they're part of this conversation, or do you feel like they'll be potentially put to the side while these other kind of alternatives are evaluated?
So that's a great question, and it's a challenging question, but it's somewhat easier to answer based on what DOL has already done this year. And so I would say that in all likelihood, we will see crypto treated the same as other asset classes, to the extent that all asset classes are put on an equal footing. And kind of how I get there is the Biden administration issued a compliance assistance release that said, we're not telling you not to invest in crypto, but be ready for us to investigate you if you do. And then the Trump administration withdrew that compliance assistance release earlier this year, saying that in their press release, they said that DOL doesn't pick essentially asset class winners and losers. And so I think the discussion we're having about asset classes, whether it's private markets or digital assets that can be accessed through public markets, are likely to be a linked conversation, whether folks want it to be or not. And it's because if DOL is going to say, and I think, Barbara, this is a point you made at the beginning, which is the neutral ground is let fiduciaries fiducie, leave it up to fiduciaries to pick what's prudent. If DOL is going to adopt that position, it's tough for them to say, we're going to adopt a position of saying, let's let fiduciaries make the best decisions they can. As a regulator, we're not going to tell people what to invest in, and then simultaneously turn around and say, but we have special rules for this asset class. I mean, I think the focus that, of our dialogue and most of the dialogues we're having have been on private equity, private credit, private infrastructure, and private real estate. But I'm sure there's other people who are looking at, whether digital assets make sense in a portfolio. And one of the funny things is that if you look at the period of time between the issuance of the Biden compliance assistance release to its revocation, the best spot to have been invested would have been digital assets. So it just highlights the challenge of figuring out what's going to make the most sense over a given period of time.
Yeah, that's interesting. I want to talk a little bit about the idea of participant education around this issue. As we said before, now in this case, participants ultimately take the risk and share the rewards of their investments. It sounds like the recent surveys that are coming out is about half of plan participants are at least somewhat knowledgeable about alternatives. Somewhat knowledgeable could be pretty wide swath of, I don't really know much at all, to, yeah, I actually know things pretty well. Kevin, you raised a really interesting point during our prep call that I hadn't thought about, that with auto enrollment and default investments, people being defaulted into target date funds, how much do they really understand about their current investments, the current target date fund strategy? So I thought that was really interesting, because I think, again, with all the defaults, people end up in something that they may not understand, but they feel good about it because it makes sense.
Yeah. I mean, this is kind of I know one of the critiques of including private markets inside targeted funds is that it's more complex and that participants won't understand it. And there's a tension between essentially the goal of ERISA, which is to maximize retirement security outcomes, with this separate goal that we've identified, which is that we want our participants to understand what they're doing because we're giving them choice. And in most areas, what we've done kind of as a country from a policy standpoint with auto enrollment, auto escalation, and default investments is we've said, participants may not make the best decisions. Why don't we give them nudges and default them into things that we think are going to maximize their retirement outcome? Whether it's, yes, you're going to participate in the plan. Yes, you're going to contribute to the plan. Yes, you're going to invest in a target date fund instead of, having your money sit there uninvested in cash. And so I think the discussion we're having around education is important because at bottom, we do want participants to feel like they have control. We want participants to make good decisions. And for folks who want to opt out of these things, we want them to know what they're being opted into so they have the ability to opt out. That being said, when I look at what a prudent fiduciary is supposed to do, a prudent fiduciary is supposed to be kind of myopically focused on maximizing retirement outcomes. And if there's tension between the goal of what a participant understands today and getting them to a secure retirement, I mean, I'd hate to live in a world where we say that, because you work at Joe's mechanic shop, you're going to have basic investment options that lead to worse outcomes than if you work for Katie's engineering firm, where we're going to give you the best tools because we think you'll understand them. ERISA shouldn't discriminate against workers who are not as educated.
That's interesting. I'd love, Jonathan, for you and Katie to weigh in as well on the education issue, educating both the end user, the investor, but also the plan sponsor. So I'd love for you both to weigh in as well.
Sure, I can jump in. I would say education is the number one action that at least a lot of the trades have been participating in. I know that at DeCalta we've spent a great deal of time on developing principles for the industry. So that was our way of outreaching to the other trade organizations as well as to plan sponsors and consultants. But when we got together, we looked at all of the things that our fiduciary framework had looked at. So we looked at value for money, where we touched on fees and why participants at that level, why would they want to invest in the private markets? You would hope they'd want to achieve either enhanced growth or help to minimize risks. We also looked at, and we spent a great deal of time, and your touch on the digital assets and that aspect is very interesting, because we spent a majority of our time on private markets and the operational functionality. So how do you put something that's illiquid into a daily environment? And from a valuation standpoint and a transactional standpoint. So we did look at valuation. We also looked at liquidity and where that liquidity can be sourced from. So in other words, is it in product? And I know it was talked about in the last panel. Is it within, let's say, a sleeve that a target date fund is allocating to? Is it within the target date fund vintage itself? And who's managing those responsibilities and liquidity characteristics? So those types of things we had touched on as an industry, and these again. The members of Deculta represent really all facets of the ecosystem. So we're getting perspectives that are from the consulting community, the plan sponsor community as well. And I think, from the education standpoint, it's educating. This is a perfect forum. So today is a great forum for education to those that are on, as well as to other trades, but to discuss the risk and rewards and why something may cost more. We understand private markets cost more to administer. I think that's a very common theme that we all know, but it's educating at the participant level and who touches that participant. There's an onus on the record keepers. There's an onus on the record keepers representatives that deal with the participants to have education. I think the level of detail of that education is something that the DOL can play a part in on how far to go with it or not. But I think as an industry, it's important for all of us to educate on the basics, why. What's available today? How are even systems outside the U.S. are investing in alternative investments? We spent a great deal of time, not only and years ago, looking at the Australian superannuation system and how they've mandated not only participation but also the allocation of private markets. Also, what's happening in the UK. All of the systems, it seems, outside the U.S. are ahead of the U.S. when it comes to private markets and DC plans. That's something that needs to change, and it's something that we're focused on, and I think the industry can help. I think debunking a lot of the myths that we touched on earlier also helps, and I think the media and the press and those that are involved, the narrative again should not be buyer beware. It should be, why haven't the participants in DC plans have access that defined benefit plans and even outside of the retirement plan community? Why haven't they had that same type of opportunity set to reach across the different asset classes?
But Katie, how do you think plan sponsors are seeing that?
Yeah, the education piece to participants is one of the key things that gets highlighted all the time. And when we start to have these conversations, a lot of plan sponsors take the mentality of, if I don't understand it yet, and you're giving me this, direct advice personally, how are my participants going to understand it? And so I think it's really, having to make an effort as an industry, if we do, believe that this is the right path to go down, to have broader education, kind of as Jonathan mentioned. At the same time, there's a lot of information out there that shows that participants don't really diversify in a way that most prudent investors would say that they should. We see a lot of single fund holders and plans. We saw a lot of concentration of assets into just a couple strategies. We see that participants don't even really understand how a TIPS index performs. 2022 is a great example. The number of questions around, why is my TIPS index losing money because it's a treasury, related investment? Shouldn't this be protected? It was very interesting to kind of get into the mentality of a participant. So I think that there's a lot of effort, just broadly speaking, on round investing that still does need to happen. I definitely believe that there are certain facets of populations that probably are already better versed in private investments than others. But I think, again, it's a collective group effort that needs to happen, that it's going to just take time for this to feel like it is more comfortable, because it's not something that a lot of these individuals have had access to before.
So in terms of a trajectory, because we were talking about, in the first part of the panel, we were talking about guaranteed income, which, many of those solutions have been around for a while. I mean, some are new, some are new, but
Yeah.
But when I compare the two issues, that one feels like a bit more of a mature market than what we're talking about right now, where a lot of the products coming to the market are brand new or just being developed. So from the plan sponsor adoption side, do you see a similar trajectory? It's just going to take a while for.
I do. Yeah, just based on current conversations, I do think it's going to just take time to gain comfort with that. So, I can't put a direct number on it by any means, but it's just going to take time to get comfort with it. And also for plan sponsors just to get comfort with and figure out the right way to communicate with their participants.
Great. Well, this is a policy forum, so I do want to talk policy for a couple of minutes. So, Kevin, you've been talking to some of the different agencies, Department of Labor. What do you think makes the most sense here? And timing wise, when do you think we might see something?
I mean, so that I think we'll see things in the next couple of months. If we look at policy, there's best, better, good. I think we all would think that best would be if we saw legislation that made it easier for folks to think about every asset class in kind of a neutral way, just to make it abundantly clear, even if the statute's not that clear. Now, legislation is very tough. It requires 60 votes in the Senate, so I think we're going to set that to the side for what we're going to see in the near future. In terms of the near future, DOL already acted a little bit on the looking back at prior guidance to see what needs to be updated to put alts on an asset class on a neutral standing. There's a tip sheet that they did with target date funds when target date funds seemed new. It wouldn't surprise me if they updated that tip sheet or did another tip sheet around how to think about including alternative asset classes in 401k plans, particularly inside multi-asset class asset allocation funds, as DOL calls them. There's two rulemakings that they have on their agenda where they can provide more clarity. First off, they've told courts repeatedly they're going to redo the Biden-era ESG rule. When Republicans do the ESG rule, they tend to call it the financial factors rule. They focus on the framework for fiduciaries making investment decisions more broadly. When Democrats have done it, they tend to focus more on how ESG can be incorporated into that framework. Because the Republican rule tends to be broader, it's another area where we may see guidance around how fiduciaries should be thinking about these products. They were told in Secure 2.0 they had to issue a rule, I think by the end of this year, on how to benchmark multi-asset class funds. Now, agencies look at congressional demands as recommendations, so they may miss the deadline. But I'd be very surprised they weren't working on that rulemaking. And it's useful to plan fiduciaries who are considering these products to have a clear framework for benchmarking. The other thing, and I think this is kind of more of a red herring at the moment, is there's been some talk about doing a regulatory safe harbor, which would say, plan fiduciaries, you're acting prudent if you allocate to a multi-asset class fund that allocates, a certain percent to private equity, and it does X, Y, and Z, and you consider A, B, and C. The challenge there is that, it's very easy for DOL to tell you what its views are on what it thinks is prudent. It's very easy for DOL to tell you that it's not going to investigate you or come after you if you do something. What's very tough is for DOL to tell a plan fiduciary that they can't be sued by a private litigant. And it's very tough, particularly in light of some of the Supreme Court cases recently, which have said that, if an agency's decision isn't consistent with the statute or seems to be a stretch, courts make up your own mind. So to me, the regulatory safe harbor, it's a route that could take a lot of time and ultimately not lead anywhere. So those are the things. If we want to address litigation risk, the other thing that people aren't talking about, but what DOL could do to be very effective here, and it feels weird because we usually think of policy and litigation as separate tracks. But DOL could get involved in some of the cases where plan fiduciaries are sued for innovating or where they're sued for whatever reason. And they could put amicus briefs in on behalf of some of the plan sponsors who are defending themselves against allegations that, whatever they did wasn't prudent. If DOL were to start getting involved in these cases, I think that would send a very clear signal to the plan sponsor community that, they're not there on their own. They're not left alone. If we look at the SEC, I talked about the guidance they've issued around accredited investor, qualified purchaser. you can build these products today. They require some opacity. At bottom, it's the rules are silly. They require asset managers to hire folks like me to work through them, and you end up building products that work well. They're good investment products. They can be good investment products, but they feel kind of weird because you're keeping secrets from the participants. And if we look at the SEC's guidance in every other area for the past 50 years, the SEC has generally been, be transparent. Transparency is the key. And it's time that they align the, transparency with this. At bottom, I don't see a world where the US moves to where the UK is, where, the Mansion House Accords, they're up to, essentially they're targeting a 10% allocation to private markets in their defined contribution schemes. But I do see that in the next year or two, we're going to see a wave of regulatory guidance that puts private markets on a more equal footing as other asset classes. And ultimately, if you have a plan that's managed by Senator Warren, I would expect that plan not to allocate to private markets. But if you have a plan that's being managed by, Senator Cruz or Senator Tuberville, and I'm just using them as examples of folks who may be fiduciaries for plans. I wouldn't wish that on anyone, but somebody's got to be a plan fiduciary. You'd see those plans allocate to private markets in a meaningful way. Because, at bottom, it's very odd to see the divergence between how defined benefit plans invest and how defined contribution plans invest.
No, that's great. Thank you. Let me just pause here. If anyone has a question for our panel, you can type it into the chat. We'll give that a minute. I did just want to ask, I wanted to ask one more question, and then we'll see if folks have any questions. We talked in the retirement income conversation, talked a little bit about, people who are, whether it's conversions or it's people changing jobs, moving, portability, liquidity, that kind of thing. Jonathan, has your group thought about how technology, automation, middleware, that kind of thing could really help facilitate and at least take away a few of the barriers? What are you all thinking about there?
Great question. I would say it's imperative for technology to help with everything from valuation estimation. So, for instance, continuation vehicles where you may have a CIT or a collective investment trust that invests in, let's say, interval funds. Each of those funds, and I don't want to go down a rabbit hole with this, but each one of those funds, let's say, that a CIT can take advantage of may have different liquidity characteristics, and the valuation of those funds and or at the CIT level can help. So there's already a lot of different firms that I've had conversations just within the last, I would say, year, that have helped facilitate a lot of the movement with valuation from an operational standpoint, but also I think where we're seeing with the record keepers that are, let's say, a large record keeper is deploying an alternative investment platform. That connectivity from the record keeper to the investment fund or firm all the way down to the participant level is all based on technology and how can it be facilitated. So I think it's an imperative. And we had done a paper on modernizing retirement savings about a year ago that really touches on the intersection of alts and the progression of different types of alternative investments over to last year up until the way that technology changes the roles that are being applied within our ecosystem and how that can help facilitate whether it's on the record keeping side or whether it's on the investment advisory side. So all of these platforms that you're starting to probably hear about in the media are platforms to provide different types of private markets, let's say, whether it's on the retail channel all the way through to the retirement ecosystem. And we have to have technology and I think I'll let you go, Katie, and touch on this.
No, I definitely agree with a lot of what you're saying. I think really it depends on the asset type can also have a major, aspect that comes into play here too, as well, in terms of liquidity profile and what you're having to consider with valuations and income generation and when that happens for payouts. So there's a lot of complexity here, and absolutely agree that technology is going to be a major aspect in terms of helping to make this a lot easier, especially with portability. We have, there are ways today just by, with what exists in terms of unitization that you can still, use, especially with separate custodial relationships to make these things portable across record keeping platforms.
Great. We did have a question on what is your view on investment reporting requirements potentially not being required quarterly? So does anyone want to take that, Kevin? What are your thoughts?
I mean, I feel as though that was a something that was recommended to the SEC by the president in a tweet, I think earlier this week, related to public markets. I think we've talked about the convergence of public and private markets in a number of ways. The convergence we've seen in kind of my career has been that private markets have taken it upon themselves to be more disclosure oriented than they're required to be. So I didn't anticipate that the pivot was going to be towards public markets being less disclosure oriented as a way of, bridging the rest of the gap. So I don't know if it's a good policy idea or not for public markets. I think it's outside the scope today of what we're focused on. On the one side, I think there's arguments that companies then manage towards quarterly earnings instead of long-term earnings. On the other hand, less disclosure, regularly it inherently doesn't feel great.
Yeah. No, thank you. I didn't mean to put you on the spot with that, but
no worries.
Kind of an interesting conversation. Well, I would love to thank our panel so much for a really robust discussion on the issue, and I'm sure lots more to come on this for sure. So John, could you just pop up so first of all, thank you to our panelists today, those from the last 2 days. It's been a great 3-day series. Just want to let you know what's coming up. On September 25th, we did an oversample with our retirement confidence survey. So there's a webinar on that coming up. On September 30, there's an EBRI webinar. We have our EBRI and SHRM, the Society for Human Resource Management Health Benefits Symposium on October 22nd, and our Financial Wellbeing Symposium on the 11th. I hope you all can make some of these events and webinars. And of course, if you're not an EBRI member, everything that we do is really because of our members. So please think of us as you go about your day. So thank you so much to everyone, and really appreciate it, and look forward to talking to you again soon.